From New York City for our audience worldwide, Bloomberg Real Yield starts right now. Coming up, Chairman Powell teeing up rate hikes, Bank of America calling for 7 this year, fueling a volatile first month of 22. We begin with the big issue to March and beyond.
As we approach that March meeting.
In March, it's go time.
We'll get more clarity.
We have seen a massive migration up in expectation for rate hikes.
The Fed needs to be very careful.
We have Bank of America at 7.
We start to hear talk of 7 interest rate hikes this year.
The center of gravity is now 5.
The market is expecting a significant amount of tightening.
More and more aggressive monetary tightening. We're at a turning point.
The question is, does the Fed have to tighten the screws more than that?
It'll depend on what happens with the inflation environment.
There's a lot left to be determined.
We're, walking a tightrope here.
Joining us now to discuss is SocGen, Subadra Rajappa, Nuveen's Tony Rodriguez and Gershon Distenfeld of Alliancebernstein. Subadra, let's begin with you and let's start here. Just how far do you think this Fed is willing to push things?
Well, it's hard to know, right? I mean, if you listen to Chair Powell's statements, he did not deliberately commit to any sort of preset path of rate hikes. I mean, what we know is that they're going to hike rates at the March meeting. But beyond that, it really is going to depend a lot on the data. We know that they feel that inflation is higher than what their projections were in the summary of economic projections in December. We also know that they feel that the labor market is strong enough to be able to withstand a more aggressive path of rate hikes. But that said, the market is not really willing to sort of look at the longer run and say that the Fed's going to be able to orchestrate a prolonged period of expansion, because the terminal Fed funds rate did not budge at all. What we did see was the market start to price in 5 hikes, for this year. So it's really about the longer run, and I think the Fed's going to be very cognizant of that, because that's ultimately what decides how long this expansion is going to last.
He talks so much about the strength of this economy, how much stronger this labor market was now versus back in 2015. I'm so pleased you brought that up, Subadra. This is what he had to say.
I think there's quite a bit of room to raise interest rates without threatening the labor market. This is, by so many measures, a historically tight labor market.
Gershon, what did you think when you heard the Fed chair say that earlier this week?
Yeah, I thought the Fed chair was just giving himself and the Fed optionality. Like the whole idea, Bank of America is calling for 7 rate hikes. I'm sure other people are calling for 3. The market's pricing in 5. Who knows? I think the Fed will tell you they don't know. What they're basically saying is, look, they were more hawkish this week than anyone would have thought 6 months ago. And it wasn't particularly surprising when it came to, given what's happened. What the Fed is saying is, we're going to look at the data. We're going to see where inflation is. Look, if the supply chain bottlenecks work themselves out over the next few months, if starting to tighten policy, withdrawing stimulus leads to inflation coming down, they're obviously not going to go as high, or they'll pause, or go less frequent, whatever it is. But he gave himself the optionality. He specifically said they're willing to hike 50 basis points at a time. They're willing to hike every meeting instead of every other meeting. So all options are on the table. If inflation stays stubbornly high, maybe we get 7 or more rate hikes this year and into 23. But if it comes down, you'll see more moderation.
Well, Bank of America are running with it, so let's bring you the quote. The Fed has all but admitted that it's behind the curve. We now look for 7 25 basis point hikes this year and a peak funds rate of 2.75 to 3. This should affect the economy with a lag, weighing on 23 growth. Tony, just run me through your thoughts on that. 7 25 basis point hikes this year and a peak in the Fed funds of 2.75 to 3.
Oh, good to be with you, Jonathan. It's very certainly, high level of rate hikes here being predicted by Bank of America. We've seen a huge pivot from the Fed back in September, moderately dovish, we would argue, to now pretty hawkish. They've eliminated forward guidance for the first time in well over a decade. We all know that the job of the Fed is to, pull away the punch bowl when the economy's hot and inflation's running high. We think that 7 hikes is probably the equivalent of taking away the punch bowl and tipping over the entire bar, shutting down the party. So we don't think the economy can handle that in 22. Our view is you'll get 4 tightenings this year. You'll also have balance sheet reduction, call that the equivalent of a 5th tightening. And you'll continue to see tightening in early 23. So we don't think it's 7 this year. We think that the curve would flatten pretty dramatically, potentially invert at that point on 2s10s, and that might be enough to really destabilize broader financial markets. And then maybe we'd get to where the Fed put is suddenly in the money, even though we know that that Fed put has a much lower strike price today than it did in previous hiking cycles.
We'll touch on that Fed put a little bit later in the program. Subadra, I think Barclays asking the right question now. Are we at the point of maximum hawkishness and policy mistake fear? I just wonder on the maximum hawkishness, I'm sitting here asking myself, where are the upside surprises going to come from now? We saw a little bit of that with the ECI this morning. Yields backing away as that came in at a different level. Where are the upside surprises going to come from? Where's the hawkishness going to come from? If you've got Bank of America at 7 and the market's shifting towards 5, how do you really beat that, Subadra? Do you start to lean the other way?
Well, I think my instinct is to lean the other way, but again, there's a lot of variability. Where I see the hawkishness coming in is from the perspective of maybe supply chain disruptions getting a lot worse, maybe contagion into emerging markets, China. We're seeing a significant sort of slowdown in growth there. So those are the concerns, broadly speaking, on the inflation front. But otherwise, it feels like the market's very efficiently priced for rate hikes for this year. I just don't see us pricing in 7 hikes for this year without really a whole lot of clarity on the data over the summer. I mean, the expectation, broadly speaking, even for the committee, is that base effects will kick in, and that in middle of this year, like second and third quarter, you should start seeing inflation start to decline. If that sort of trajectory happens, I just don't see the rush for the Fed to have to hike at every meeting this year.
And we don't even have the clarity, Gershon, on the balance sheet reduction either, and what kind of impact it's going to have on markets, on the economy going forward from here. Gershon, what do you think the relationship is at the moment between this move on the front end and what's going to happen further along the curve, the shape of the curve and how you think it's going to evolve and what's going to influence that in the coming quarters?
Yeah, I think clearly we think the curve's going to continue to flatten. I think history has shown that's what happens during a Fed hiking cycle. I think what we saw this week was a microcosm that, you had initially the yields at the long end sold off just as much or almost as much, and then they rallied all the way back yesterday. And what that's basically saying is the U.S. doesn't live in a vacuum, right? At some point, we start getting, that's why despite the high inflation numbers, we start getting much above 2% in the 10-year. That's going to be very, very attractive to many foreign buyers. So we think there's a limit, and if the Fed has to go faster, quicker, we could even see an inverted yield curve. That's certainly a risk out there.
Tony, your thoughts on this yield curve?
Like I said, I think they're going to front end the hikes this year. So you'll see it start at the March meeting and maybe consecutive for the first 3. But then we think it'll slow down in the second half as some of the inflation data begins to moderate, in our view. So we think you'll see a flattening. We don't think you'll get to curve inversion on 2s10s because we don't think you'll be pricing in 7 rate hikes. Of course, if the data goes the other way, employment cost index appears to be, stuck at this high level over the next couple of months and not recede, that then could drive us into an inverted curve and those 7 rate hikes.
And then the worry, Subadra, on hiking into weakness. This is how quickly this story has moved. We've had this massive year 2021, these inflation fears, a Fed response to it, and then every kind of downside surprise, every single downside surprise we get, people would extrapolate that out through the rest of 22 and would start getting very nervous about what's still to come for the year ahead and beyond. We saw that with consumer sentiment a little bit earlier this morning. Comes in at a decade-plus low, and the worries start. Subadra, factor that into your thoughts on where you think this curve is heading.
Yeah, no, I mean, that's definitely a concern. I think that the curve, remains flat for a good portion of this year. Really where I see prospects for some sort of term premium buildup is based on how the Fed decides it's going to unwind its balance sheet. I mean, there's a potential that they hold Treasury bills. They have a bunch of mortgages that could be paying down. So they do have ways in which they can steepen out the curve and build some term premium if the curve gets flat. But to me, I mean, 2s10s at 60 basis points and the entire curve well below 60 basis points is troubling. And then you look 2 years out, the curve is extraordinarily flat. So the market's basically pricing in the potential, if you will, for a meaningful slowdown in growth in a 1.5 to 2 years' time. Again, this goes against what the Fed's trying to do, which is to prolong the cycle as long as it can. It doesn't want a shorter and faster cycle. It wants a very prolonged period of expansion.
Are the options that binary for you, Gershon? Do they have to choose between a long expansion and inflation? Can they do one without hitting the other?
Well, look, we're in many ways an unprecedented environment, or at least in my career. We've certainly had shocks over the past few decades, whether it was the telecom crisis, the financial crisis, European debt crisis, et cetera, et cetera. I think this is the fastest things have changed. And in some respects, we're in very uncharted territory, right? Growth is very strong at a time when we're focused so much on the delta that we're wrapping up QE and we're going to hike rates, but we're still very accommodative by historical standards. And I think it's going to, again, in the next few months, going to be very telling. And the Fed could not have made clear. I guess you want to talk about the put, maybe the next segment. Yeah. I think the put's been restruck here. I don't think that they're going to worry that the equity markets are down, back now to October levels. Not exactly, this huge sell-off. Maybe we got down 25% of equities, they would care. They're going to do what they have to do to fight inflation. That's first and foremost more important, I think, than prolonging the growth cycle.
We're going to talk about that next, Gershon. Gershon Distenfeld sticking with us alongside Tony Rodriguez and Subadra Rajappa. Coming up next, the auction block, a Fed rate decision and surging volatility pushing borrowers to the sideline. That conversation up next. This is Bloomberg. Live from New York City for our audience worldwide, this is Bloomberg Real Yield. It's time now for the auction block, where we kick things off over in Europe, recording its slowest week of the year, pricing just 24 billion euros, with borrowers looking to avoid surging volatility. A quiet stretch in US high-grade markets as well, weekly sales hitting 2.6 billion, well short of projections and missing estimates for the first time this year. But the junk bond market remaining open, recording its busiest day of the year Thursday, an offering from Athena Health pushing weekly sales above 6 billion. On this market, we need to talk about the Fed put. This is what Guggenheim's Scott Minerd had to say.
The option for Fed puts at this point are running out, given the high valuation. So it would seem to me to make more sense to let's just start reducing the size of the balance sheet, which will slowly reduce the supply of money or the growth of money.
Back with us, Subadra Rajappa, Tony Rodriguez and Gershon Distenfeld. Gershon, I promised we'd revisit this, so let's do it right now. Your thoughts on how things have changed in this moment versus the previous cycle and what we saw repeatedly over much of the last 10 years?
I think what we saw in reality and what the market came to expect was that the Fed would bail us out. We were through a cycle. We were hiking rates a number of years ago, right, 17 and 18. And, as soon as we got that volatility, the Fed went out of its way to sound more dovish. I think this time's different. Again, like I said in the last segment, maybe if we're in real bear market territory and the S&P was down 20% plus, things would change. But I think if you listen to Powell, maybe he didn't outright say it, but he made very clear, I think, just implicitly, that if inflation remains stubbornly high, which is, let's be honest, let's be a little humble, impossible to predict. Six months ago, we all thought it was transitory, right? So if it stays stubbornly high, they're going to act, and they're going to act aggressively until it gets under control and are not going to worry as much about markets.
Subadra, do you agree?
Well, it depends. I think that what you're seeing so far with even 4 or 5 hikes is a normalization of policy. You're going from the zero lower bound to something where I would say it's still going to be very accommodative policy-wise, because you're looking at, say, 150 or so in Fed funds. Policy is still very accommodative. The question is, do they actually get to tighten to the point where policy is actually restrictive? And I'm just not sure we get there, this year or even next year. So I think for the most part, they're going to be very measured after they sort of get interest rates to around 1.25% or 1.5%. Beyond that, I think it's going to be much more dependent on financial conditions.
Subadra, can we just sit on that just for a little longer? A lot of people talk about where policy is going to be restrictive, and they use words like, we can calculate that, we can work that out. How difficult is that actually in practice to work out? Isn't that just an experiment in real time?
I definitely think so. I mean, if you look at the example of the last cycle, right, they kept raising rates till the end of 2019, and then next thing you know, they had to sort of quickly pivot very rapidly because of this sort of sell-off we saw in equities. So really I should say 2018, sorry. I think that's sort of the dynamic that they're looking for, is that a lot of times they keep raising and until they get to the point where they see financial conditions start to tighten, and then they're going to have to reverse course. So it's really more experimentation than knowing exactly where and when to stop.
Tony, I'm pleased we mentioned the labour market quote at the start of this show, because when I heard that quote, it just reminded me of the back end of 2018, to Subadra's point. And I put those two quotes together. There's quite a bit of room to raise interest rates without threatening the labour market. That's Chairman Powell this week. Back end of 2018, we may go past neutral, but we're a long way from neutral at this point, probably. Well, wow, that was a bad call at the end of 2018. So, Tony, how on earth do we know? And on programmes like this, where people seem to have more belief in the people that talk with conviction and confidence, well, neutral is here, and this is where there's trouble, and we can keep pushing rates higher. And no one on this programme's doing that. But, Tony, just how much of a guessing game is it for you?
Jonathan, I think the reason it's a guessing game is because it's such a multi-factor model. So it's not just about the rate, it's what's happening more broadly with economic conditions, with inflation, with foreign growth, et cetera. So how the market responds to all those factors really drives much of the Fed's decision-making. The reason the put is so much lower this year really comes down to their mandate. In previous last 15 years, they've been looking at a market where GDP growth was struggling to get to 2% real, and inflation was below the 2% target. We sit here in today's environment with GDP growth well above potential and inflation well above their 2% target. So they certainly are going to have a much lower price level in the equity market for that put, and potentially also for the credit market. Our view would be that the credit market might give the clearer signal to the Fed as to when maybe policy has gone too far in terms of looking at risk premiums in those markets rather than the equity market.
And it did in 2018 in a big way. Gershon, I want to turn to credit and just sit on that for a moment and read out your quote for the audience. Within credit, it's a tug of war between tight spreads and tighter monetary policy against growth that is still solid and improving fundamentals. How difficult is this moment at the moment for you, Gershon?
Well, it's a tough market in that there isn't a lot of dispersion and there isn't necessarily a lot of opportunity to add kind of what we like to call active alpha. But I think Tony just brought up an excellent point. The credit markets are behaving a lot better than you would have thought. First of all, through yesterday, the S&P was out, rallying today was down 7.5%. High yield was down 2.4%. But the most important factor is triple C's are outperforming. If the credit markets were telling you that, there's a risk the Fed's going to go too far, growth is going to slow dramatically, triple C's should begin to underperform. We have not seen that yet. I agree with Tony. That's something we're going to have to watch very, very carefully. And if we start to see weakness in lower credit quality, if despite higher rates, higher credit quality outperforms, that's going to be a signal that maybe we're in danger zone from the Fed overreaching.
Gershon, you're a student of market history as well. When you look back through previous cycles in moments like these, and there aren't many of them to be fair, do you have more confidence in the continued resilience of credit in those pockets of credit versus, say, equities at the moment?
Yeah, look, I think both are very, I would say, rich by historical valuations. That doesn't necessarily mean that either is going to suffer in the long term. We know there's very little correlation between short-term returns and valuations. There's a big correlation with long-term returns. But I think here's the difference. And again, I'm not an equity expert. I know the equity market, the composition has changed. You can't just look at the level of spreads per se, which is probably everyone's favorite indicator. It's a completely different market. 2 years ago, 3 years ago, the market for actually most of the past 2 decades was about 40% double Bs. Today, it's 55% double Bs. Look closer to the European high yield market, which has always been higher credit quality. So tighter spreads are justified. I continue to think, and this is something we've talked about many times on the show before, that longer term returns, and I think that's true in the equity markets, it's true in the credit markets, are going to be lower than they've been over the past 10 or 15 years.
Gershon Distenfeld sticking with us alongside Tony Rodriguez and Subadra Rajappa. Still ahead, the final spread, the week ahead, featuring the US jobs report and a number of global rate decisions. That conversation just around a corner from New York. This is Bloomberg. Live from New York City, this is Bloomberg Real Yield. It's time now for the final spread. The week ahead, coming up, rate decisions in focus, very much so around the world, with the RBA kicking things off on Tuesday. On Thursday, it's the ECB and the Bank of England's turn. And finally, wrapping up the week with the main event, it's the US payrolls report on Friday, just around the corner. With us now, Subadra Rajappa, Tony Rodriguez and Gershon Distenfeld. Subadra, let me come to you. Talk so much about the Fed. The Bank of England's already made a move. Keep coming back to this one on the ECB. Can the ECB really sit this out, Subadra? I saw the German print for GDP this morning. Dreadful. Do you think they can?
I think they will. I mean, I think that it's still too premature for them to show any sort of pivot. The market's already pricing in a very aggressive, policy normalization, rate hikes for this year as well as next year. So, I mean, they're still focused on tapering asset purchases and moving away from the PEPP to the APP, and that's really where their focus is going to be the first quarter, especially given the slowdown with the Omicron, just like what the Bank of Canada did. I think that their modus operandi is going to be very cautious as they're still very actively purchasing assets till March, and then they're going to switch to APP.
Let's start the rapid fire round right there on that question. Rate hikes from the ECB this year. Yes or no? Do we get any? Yes or no? Gershon?
No.
Tony?
No way.
Subadra?
No.
Quickly on credit spreads, wider or narrower from where they are by year end? Wider or narrower? Tony?
Modestly wider.
Gershon?
Unchanged.
Subadra?
Wider.
Can I get to the final question? You know what it's going to be? Because I keep going back to this. It's a moving target. If you put all these shows together over the last couple of months, you'll see how these numbers have just gone up and away. How many rate hikes this year? How many rate hikes this year from this Federal Reserve? Subadra?
3.
Tony?
4.
Gershon?
My very sophisticated model says an average of 5.38.
Gershon, thank you, buddy. Alongside Tony Rodriguez and Subadra Rajappa. I need to get my team out of here before the snow starts coming down in New York City. I'll see you same time, same place next week from New York. This was Bloomberg Real Yield. This is Bloomberg TV.